Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Jay Gragnani, Head of Research and Client Engagement with Nasdaq Dorsey, Wright, to discuss if we are in for more chop and volatility in the market. Jay, it's great to see you as always. Welcome back to Trade Talks.
Jill, great to be here. Thank you for having me.
All right, you got it. And given the recent market volatility that we're seeing, is this a general pullback, or do you think it's a sign of further market deterioration?
Sure. So first of all, the month of May is just one of those months in the market that invokes some bit of volatility, at least perceived volatility in the minds of many investors. And that really goes back to this old adage of sell in May and go away. And that sell in May and go away adage is something that we've talked about before, something that there's a lot of history behind it just to suggest that there is some seasonality to the market, that the market just tends to do better during the periods from November through the end of April versus the May through the end of October time period. And while there's a lot of history, 70 years worth of data to kind of support that evidence, the reality is over the past 10 to 12 years, it hasn't necessarily been that case over that 6-month period. Nonetheless, these 6 months are just the months of the year that tend to be a little bit more volatile in the marketplace. With that said, so far this year, it has been, spot on. The volatility has come back in after a tremendous move in the market in the month of April. And really, frankly, over the course of the past year or so, with not a lot of volatility in the market. I mean, we haven't seen a 10% pullback in the market in well over a year now. And what we've seen here recently is basically, if you look at a lot of the major equity indexes, is pullbacks towards more normal conditions and consolidation across a lot of individual names. And so, there's a lot of signs that is a positive thing as things have calmed down a little bit, consolidated back towards the middle of their trading band. If we look at it, by and large, trends remain positive. And, one of the indicators that we look at to give us a general sense and gauge of the health of the overall trend of the market and looking at the individual stocks are looking at what we call PT indicators, standing for positive trend. So the percent of stocks that are in a positive trend for the S&P 500, as an example, can give us a good sense of how the markets are trending generally. Right now, almost 90% of stocks in the S&P 500 are in positive trend. So on the surface right there, that is generally a positive thing. We have seen some deterioration among some of our shorter term indicators to suggest that it wouldn't be surprising to see a bit more volatility, a bit more chop in the market. But right now, we haven't seen anything to suggest that the shift of being in generally positive trends to negative trends for the market at large is looming around the corner.
And Jay, shifting gears a bit, let's talk about energy, as it's recently been in the headlines with the temporary pipeline shutdown. What's the outlook for crude and commodities in general? We've seen a number of areas pull back over the past 7 to 8 trading sessions.
You're right. And we, being on the East Coast in Richmond, Virginia, certainly experienced a period of, I'll call it panic around Richmond, Virginia, as there were gas stations running out and lines around certain gas stations. Everything seems to be back to normal now, as hopefully is the case across the entire East Coast. But that has not been new to the energy markets in the sense of seeing a lot more new demand for gasoline, for crude oil, as crude oil has recently moved back up to $66 a barrel, and it has performed very, very well over the course of the past 6 to 8 months. But so have a lot of the other areas of the commodity markets. I mean, we've seen a broad rally across a lot of commodities. And to the extent that commodities, when we look at it relative to other macro asset classes that we evaluate, so think U.S. equities, international bonds, commodities is ranked number 2 right now. And it's there not just because crude oil has done well, but it's there because we've seen a broad rally in commodities, from energy commodities to agricultures to base metals and things like copper. And those types of things have just continued to perform well and continue to move higher. So when we look out today, commodities is a second-ranked asset class, certainly in an area that we're looking at exposure towards, and you can do so in a number of different ways. but really, commodities too. Obviously, the inflationary side of the coin comes in with commodities, and also the fact that the U.S. dollar has resumed its negative trend after bottoming earlier this year around 89 or so. It's back down towards those levels after seeing a brief rally. And so, when we look at commodities again, it's been a generally positive picture for commodities, especially for crude oil. Crude oil is pulling back pretty sharply today as we're recording this. Nonetheless, the long-term trend is still positive and still close to those highs for crude oil.
And Jay, in the last minute here, how can the audience gain access to the Dorsey Wright research platform?
Yeah, sure. So there's a number of different ways. Appreciate that. A number of different ways that you can do so. You can Google Dorsey Wright, Nasdaq Dorsey Wright, and you can go to our login page, dorseyWright.com/login or /trial, to gain access to a free trial. If you have questions, feel free to give us a call. We're here for you. Our numbers are 804-320-8511, or you can email us at dwa@dorseyWright.com. So thank you.
All right, Jay, great to catch up with you as always. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.